So costing and pricing strategies. A pricing strategy is the approach you use to set the ideal price for your product. All right, your strategy must consider factors such as revenue goals, product features, and audience, as well as competitors' prices, economic trends, and consumer demand. Something we have to consider, let's point out, is the competitors' prices. If you're selling a product and you want to sell it at a premium, right, you can't go to an unrealistic price, even though it might cost you a lot, or you find ways in way to keep your costs down so you could sell it and make a good profit. Taking into consideration, right, your competitor's price. You don't want to sell it for way too much. Say, there's Charles chocolates here, right, in Trinidad, and everybody knows about Charles, but not everybody prefers Charles. So somebody may come up with a better chocolate. Let's look at, what's the other one? I think Marshall has a chocolate, but it's sold as a premium, right? So his pricing can be so exorbitant that, you know, it is so more expensive than Charles, right? But it tastes just as good as Charles, right? So you also want to consider the competitors' prices when you because that's what they see when they go into the groceries, they go into, you know, the market and stuff, places like that. The pricing process helps a business finalize the price at which it plans to sell its products and services. Many businesses that produce and sell goods or services use the cost as the basis for setting their selling prices. So, right, one leads into the other, right? One depends on the other. One comes first, and then it will then it's like, okay, so I this is the cost I have it at. This is how I will price, right? So we have a little chart there just to show the comparison between the two, right? So your balance sheets and your income statements. On the category of time, the balance sheet should show a summary of financial position of the company at a specific point in time, where the income statement provides an overview of the financial performance of the company over a given period. So key items you want to list on the balance sheets are balance sheets include assets, liabilities like we spoke about, shareholders' equity, and it can be further categorized given more accurate information. Where income statements include expenses, revenues, gains, and losses obtained from the sale of disposal of assets. Financial analysis, balance sheets assesses the financial health of your company using financial ratio analysis, right? So when you do a financial analysis, your balance sheet will show whether it's a healthy company or not so healthy. Okay? Income statements uses gross margin, operating margins, price to earnings, and interest coverage to assess the financial performance of a company. So it does it in a different way. Yeah, some of the usages for balance sheets. Investors and lenders use balance sheets to assess credit worthiness and availability of assets for collateral. No investors is going to invest in a company, and if it goes into a loss, have no way to, you know, like trace that back, or have no way to want to invest in the first place, right? Unless these things show a positive aspect. Okay, investors, management. For income statement, investors, management, shareholders, and other use income statements to assess the performance and future prospects of a company. So cash flow statements, or CFS for short, measures how well a company generates cash to pay its debt obligations, or in some cases, the liabilities, funds its operating expenses, and fund investments. The cash flow statement complements the balance sheet and income statement. So they work hand in hand with each other. One depends on the other. The CFS, or cash flow statements, also allows investors to understand how a company operations are running, where its money is coming from, and how the money is being spent. The CFS also provides insight as to whether a company is on a solid financial footing. This is a reflection, and really for investors, they'll be looking at these things.
And what is cash flow projections? Basically, the cash flow projection is what the company expects to be coming in, right? The small business, what is expected to be coming in and what is expected to be coming out money-wise, right? What is expended, what you are expected to spend for resources, and what you get back in the sense of selling a product or skill or service, right? Ultimately, a cash flow projection is what the company is expected. It's an overview of how much cash the business is expected to have on hand at the end of every month, right? Cash flow is good for small businesses, companies, to manage flow. It could be a big difference in making a company successful or fail, right? You knowing how your money flows in and out of the organization, and understanding and predicting the flow of the money in and out of your business, however, can help the entrepreneur make smarter decisions. You yourselves, if you're a startup, or even at the businesses that we created, or services that we created earlier on in the program, how these making decisions within those businesses themselves. And these are some examples, right? These are just some facts as well. One study shows that 30% of the business fail because the owner ran out of money, right? And 60% of small businesses, owners don't feel knowledgeable about accounting. And this is a major thing as well. Us have more of a technical background myself. I am this for myself. I have more of a technical background. So when it comes to business and making business decisions, it's very difficult. But if you have these cash flow projections, you can look at figures and make better decisions on them. Right? On the other hand, if cash flow projections suggest surplus, could be the right time to buy a new piece of equipment, make investments into the company, right? Or the business itself. Could be that you're looking to expand to a new location, and if your cash flow projections show profit, you can actually do those things as well. And if it's not showing profit, you can actually hold back a little bit on making these expensive investments into the business as well. And for benefits to cash flow projections, understanding your money and where the money goes in the organization or the business, right? If it goes into paying labor, if it goes into paying for materials and supplies, right? And what money is coming back in. It helps you make more confident business decisions based on the flow of the cash. And also what is important, if you are looking for financial investment, you may be looking for loans, you may be looking for grants. It helps others build trust in your business, shows that you plan out your business well, and you're looking at certain amount of flow or profits in your business as well, right? And prevents problems before they arise. With cash flow, you can see where profits may drop. And when you see profits drop, you may want to look into why these things are happening and look to see how to rectify these things.